Before you start investing in 2026, there's something important you need to know. Most beginners don't fail because the market is difficult. They fail because they walk straight into a set of predictable mistakes, mistakes that quietly cost them thousands of euros over time. In this video, I'll walk you through the 7 beginner investing mistakes you must avoid in 2026 so you can begin your journey with clarity, confidence, and a calm long-term mindset. Let's begin with the first one. The first mistake is waiting for the perfect moment. Many beginners believe they should wait for a dip, a correction, or some kind of sign that the time is right. But here's the truth. The perfect moment almost never exists, and waiting often costs far more than starting too early. Market timing doesn't work. Even professionals struggle to do it consistently. But starting early, even with small amounts, allows your money to grow quietly through compounding. There's no perfect moment, but there is a best moment, and it's usually now. The second mistake is building a portfolio that's too complex. A lot of beginners think more ETFs mean more diversification. So they buy a tech ETF, a Europe ETF, a clean energy ETF, a growth ETF, a small cap ETF, and suddenly they're overwhelmed. It feels diversified, but in reality, it's just noise and overlap. A simple, globally diversified portfolio is almost always more effective. Not because it's clever, but because it's consistent. And consistency is a beginner's strongest advantage. The third mistake is checking your portfolio too often. This is one of the most dangerous psychological traps. Every time you check your investments, your brain reacts emotionally to small movements. A tiny red number feels like a threat. A green number feels like success. But markets are noisy in the short term and rational in the long term. Checking daily creates stress, impatience, and impulsive decisions. Long-term investors don't monitor noise. They monitor progress. Checking monthly or quarterly is more than enough. The fourth mistake is investing without an emergency fund. This mistake usually shows its consequences only during downturns. When you have no savings buffer, you can be forced to sell your investments when prices are low, the exact worst time to sell. A simple emergency fund of 3 to 6 months of living expenses protects your investments from becoming your backup plan. It allows your portfolio to grow peacefully without pressure. The fifth mistake is assuming short-term drops means something is wrong. This is where many beginners panic. A week of red, a small correction, or a temporary decline, and suddenly they believe their strategy is failing. But volatility is normal. Corrections are normal. Dips are normal. Short-term movements don't say anything about long-term success. The market rewards patience, not perfection. Staying calm during temporary drops is one of the strongest advantages an investor can have. The sixth mistake is taking on too much risk without understanding what risk truly is. Risk is not how much your portfolio moves. Risk is how you feel when it moves. If your investments make you anxious, stressed, or unsure, your risk level is too high, even if it looks good on paper. A balanced mix of global stocks and global bonds creates smoother performance and more emotional stability. A calm investor stays invested. A stressed investor sells at the worst moment. And finally, the seventh mistake, not automating your investments. Manual investing leads to hesitation, missed months, emotional decisions, and second guessing. Automation removes all of that. When you set a fixed monthly amount and invest automatically, you create a quiet, consistent system that runs in the background, regardless of your mood or the market's mood. Over time, automation becomes one of the strongest tools for building long-term wealth. If you avoid these 7 mistakes, you'll start your investing journey in 2026 with more clarity and confidence than most people ever have. You don't need perfect timing, you don't need complex strategies, and you don't need to react to every market movement. You need a simple plan, a long-term mindset, and emotional calm. If this video helped you feel more confident about investing, feel free to subscribe to Olive Wealth for more calm, evidence-based guides. Thank you for watching, and I'll see you in the next video.